the analogy I draw is like sometimes I'll open up the front hood of my car and I'm like, yep, there's an engine in
Looks
there.
good. Yep.
So what should I be looking for? Hey there, and welcome to a brand new episode of Delivering Marketing Joy. I am your host, Kirby Hasseman. Joining me today is a brand new rock star. He's a CPA, he's an entrepreneur of his own CPA firm, and he works with growth-minded entrepreneurs, and I can't wait to dive in today. It's Chris Hervochon. Thanks so much for joining me.
Thanks so much for having me. Looking forward to it.
Absolutely. So I'm the sales guy, right? I'm the marketing guy. And so this is a place in my business that I've really had to work at. So I'm excited about the things that we're going to talk about today. So for those of us who are entrepreneurs, we've heard the term cash is king, right? But how do I know how much cash, right? How much cash should my business have? Is that something you can answer?
Yeah, sure can. And it's a great question. Most entrepreneurs run their business based off of cash, and a lot of them, fortunately or unfortunately, run it based off of how much cash is in the bank right now. So, how much cash should you really have? My recommendation is to have somewhere between 2 and 6 months of your average operating expenses in cash, in reserve, in your bank account, hopefully at all times. Now, the question invariably becomes, should it be 2 months? Should it be 6 months? And that really just depends. So what we do, and you can actually go out to my website. There's a cash reserves calculator. It's on betternumbers.cpa, the website. But you can go out there and there's a questionnaire that we go through. It's going to ask you things like, how good are you at collecting accounts receivable? So if you're not good at collecting accounts receivable, you need to have more cash in your business. So you're going to lean more toward that 6 months. Are you looking to make investments in the business, whether or not that's going to be equipment or people or whatever that's going to look like? If you're looking forward to make investments, you need to have more cash in the business, and it's going to skew you um, more toward that 6 months. So it's really about, what are you looking to do in the future? How good are your operations? How risky are your operations from a cash perspective? And then that's going to skew you either toward that 6 month average or that 2 month average.
Yeah, it's great because I've this is one of those things I think a lot of us struggle with. This is the first time I've gotten an answer like that, so I appreciate that very much. So also, as a business owner, how often should I be reviewing my financials? And I guess if I'm looking at them, the analogy I draw is like sometimes I'll open up the front hood of my car and I'm like, yep, there's an engine in
Looks
there.
good. Yep.
So what should I be looking for?
Okay. So really, really bad would be never.
Okay. Yeah.
The absolute possible bare minimum would be annually. Better than
Okay.
that is quarterly, and then ideally it's going to be monthly.
Yeah.
And it
Okay.
really just depends on where you are in your business and what you're looking to accomplish and how often you can get financials. That's really the crux of it, right? Do you have a financial professional that's helping you, that's getting you financials on a monthly basis or a quarterly basis? And then that's the cadence that you should really review. But all of that to say, more frequently is better because you're working with information that's actually relevant to you right now.
Right.
The further you get away from that information. So if I've got books for Q1 of 2025 and we're sitting here in December of 2025, well, that information is not relevant to me anymore. Things have happened, right? We've all sorts of stuff has happened in the business. That information is not relevant. So I would say get yourself an accounting partner that's at least going to put the financials together for you on a quarterly or a monthly basis, depending on what your business can afford and depending on what space you're in as far as your growth. And then review those financials with that financial professional on an ongoing basis. And because they're going to be the ones who tell you the story. Like you've got the context, you know what's happening in your business and you know the why and all of that stuff. But that financial professional is going to be able to take that information, that context, and then basically bridge the gap between the context and what the story the financials are telling you. So you can kind of get that holistic view of what's going on in the business, and then you can start to course correct.
So I'm going to kind of, I don't know, probably show my hand of what I don't know, right? Because I've not been working. I have a CPA, he's great, but I don't go over my numbers with him once a month. So when I'm going over them once a month, a lot of times what I try to do is look at year over year. So if it's April of 2025, I want to see what April of 2024 looked like and look for discrepancies. So, hey, why is that number so much bigger than this number? And for me, that's a good jumping off point to see if something's out of whack. Does that make sense or is that a bad idea?
That's a great idea. I would take that probably a couple steps further, though.
Okay.
Okay, so let's just say we're sitting here in April of 2025. So I want to see April 2025 versus April of 2024, which is what you're doing. I want to see April 2025 versus March of 2025. Okay, so month over month. And then I want to
Yep.
see year to date. So year to date of 2025 versus year to date of 2024. And I want to do those variance analysis and I want to ask those questions. Now, the variance analysis that we're looking for, uh, if you're just going line by line down your P&L or your balance sheet, always start with the balance sheet, by
Yeah.
the way. That's a good tip. But
Mm.
if you're going
Yeah,
line by
that's
line down
good.
your financial statements, look at things that have a 10% variance. And then look for things that have a material dollar amount of variance too. So 10%, if the account is $100 and you got a 10% variance and it's $10, like who cares, right? So you want to have a dollar level of threshold that you're willing to tolerate as well. So look for those variances across those three comparisons, month over month, month over last year, and then year to date versus year to date. So look at those variances and then ask the question, like, what is driving this? And then once you're able to answer those questions, it's going to better help you to course correct, right? And then it's going to better help you to make those decisions that you're going to need to make going forward, and just understand like this is what's happening, this is what I need to change. The other thing you might want to do too. So if you want to go to the advanced level, is
Okay.
compare those things to budget, and you should have a budget. We call it a financial roadmap because budgets are scary. But you want to compare those things to budget and do that same variance analysis too. And that's super helpful.
Okay. All right. This is good. This is, if you're listening to this and you're an entrepreneur like me that is a sales driven, marketing driven, like I feel like listening to that last 2 or 3 minutes might be really good. I'm going to go back and listen to it myself. So thank you, Chris. That helps.
Very cool.
Um, yeah. So let's talk about CPAs, right? Like, so as an entrepreneur, I kind of expect my CPA to just be an expense, but should we be looking for our CPA to provide ROI, or is it just the cost of doing business?
Really good question. Get that a lot. It's most definitely a cost of doing business. Like let's not you can't sugarcoat that. Like you have to do a tax
Okay.
return, right? If
Yeah.
you've
Oh,
got
yeah.
bank
Yeah.
loans, you have to. There's compliance level things that you just have to do. It's a cost of doing business. And a CPA is going to help you with that. Um, But a CPA most definitely should provide you with ROI so long as you have the ideal relationship with a CPA, meaning like you're meeting on a monthly basis. You're sharing what's going on in your life and in your business. The CPA has that context. You're meeting to go over the financials, things like that. You're going to get an ROI for sure. But, huge but,
Okay.
whether or not that ROI is measurable is a different story.
Right.
Right. Okay. So examples. You self-prepared your tax return last year, 2024, and your effective tax rate is this. You paid this much in tax, and it is what it is. You did like a TurboTax kind of thing. Okay, cool.
Okay.
2025, you use a CPA. CPA says, "Hey, you should do X, Y, and Z." You meet with them before the end of the year, so before the tax year is over, where you still have some availability to put some strategies in place. They tell you to do X, Y, and Z. You file your tax return for 2025 and 2026, and they say, "Hey, Kirby, great news. Your effective rate went from this to this because we did X, Y, and Z." And then you can put a tangible dollar level on what that savings is. So you can determine whether or not you're going to get that ROI. The thing about that too is once you put those strategies in place, absent big tax law change, which by the time that this podcast comes out, we should probably have a new tax law. We think maybe somewhere like right around in there. So that we'll see how that goes. But absent a tax law change, these strategies are going to come, they're going to allow you to save money over time, right? So you just can't take it in one year. So that's one
Makes
piece
sense.
where you can't measure it. Let's just say that we sit down and we go through your financials, we do the quarter over quarter analysis, we have a really good substantive conversation. We talk about how the strategy in the business can change. We talk about how you can, update your pricing or implement cost controls, things like that. Things that you can do in the business. We have a discussion about that. That's going to be more difficult to have a quantitative impact. There's going to be a quantitative impact, but being able to measure that, that's a different story. That's a little bit more difficult. Our unofficial tagline in our business is we help you make good decisions before you make bad ones. And the bad decisions, it's kind of hard to quantify the negative, right? Like, what's
Yeah.
the opportunity cost of you not doing this thing that's going to get you audited, or not doing this thing that's going to make you lose a customer, or not, all of the knots, right? It's very difficult
Yeah.
to quantify. So yeah, you're going to get as long as you have a good working proactive relationship with a CPA and you maintain that relationship, you're communicating on a consistent basis, yes, you're going to get an ROI for sure. Whether or not you can measure all of that, different story. That's a little bit murky.
That's cool. Okay. I appreciate it. It's ironic, right? The numbers
Yeah.
guys, it's hard to get an ROI, but I do totally understand what you're saying because proving a negative is just, and I do totally see where it's like, because I've had those conversations where I'm like, oh, this person's for sale. Should I be looking at it? And going through a financial analysis of not buying that business. Yeah. Like, that might have been the biggest decision ever, right? Like, so
Oh yeah,
yeah,
for
I
sure. Like
totally see what you're saying.
how do you quantify the business that doesn't ruin your life?
Yeah, that's
It's
right.
it's hard to
That's
say.
right. That's cool. All right, final question for you, Chris. This has been great. Let's talk about an exit. All entrepreneurs sort of, I feel like that's the thing everybody wants to talk about. So, what are some things if a business owner is looking to sell or thinking about selling? What should they be preparing if they want to sell?
Great question. Number one, do it well in advance. You don't want to like fire sale your business. Like do it well in advance. What I usually tell my clients, the first person that you want to loop in is your financial advisor. The reason why you want to do that is because the financial advisor is going to give you, I'm assuming that we're going to do this for retirement, right? So the financial advisor is going to give you that number. Like, this is what you really need to exit with in order to make you have that comfortable lifestyle for however long that you need to have it. So start with the financial advisor. They're going to help you with like a number that then needs to be. Okay, cool. Then go to your CPA or go to your exit planning strategist and just say, hey, look, I'm thinking about selling in XYZ time frame. I've got this business. The business looks like this from a revenue, profit, size perspective, number of employees. This is what we do, those sorts of things. And just say, hey, like ballpark, what do you think it's worth? They'll give you a number. Probably what's going to happen is that there's going to be a gap, right? Okay, so
Yeah.
now and this is why we need to do this well in advance. So the question is, how do we close that gap? And you're going to basically do it with two levers. And I'm oversimplifying this, but you'll get the point. So the first lever is the amount of cash that the business kicks off. So generally speaking, if you're not going to strip this thing and sell it for parts, somebody's going to come in and acquire this for the cash flow of your business. So the higher the cash flow that the buyer can expect to obtain by purchasing your business, the more valuable it's going to be. Okay, so that's step one. So how do we increase the cash flow of this business? How do we make it more profitable, essentially? Cool. Number two is how do we de-risk the business? So a buyer coming in, how are we going to de-risk it for them? So good examples of that. You're the owner. Does everything fall to you? Is everything based on you showing up every single day and making all of the donuts and all of the widgets? If
Key
that's
man
the
risk,
case, well
right?
then, yeah. So now you're selling that jobby to a buyer, which is a much more difficult sell than, oh yeah, I'm on vacation 340 days a year. I just show up every once in a while, and the business is kicking off cash. So, how do we get you out of it? That's one. Two is what are the processes and procedures that are documented inside of the business, and how well are they documented? Do you have a trained team? Do you have a moat around your business? Some sort of competitive advantage. There's almost countless ways that you can de-risk this thing and make it more attractive to a buyer. But we need to do those two things in combination, most probably. So increase the cash flow and then de-risk the business. And then that's what's going to make it most attractive to a buyer. But we should only do that after we know, like, this is where we need to get to. This is the number that I'm looking for. And then I would say that usually starts with the financial advisor.
Man, this is great stuff, Chris. I really appreciate you spending the time. We've got a lot here. I'm sure people have questions for you. Where can they find more information about you?
Best way to find me is on our website, betternumbers.cpa. We've got all sorts of free resources too. Like I mentioned, we've got the cash reserves calculator. If you're interested in trying to figure out like how much cash should my business have, that's a great resource. It's free. But there's a number of other free resources on there and then on our blog as well. All can be found at betternumbers.cpa.
Awesome. This has been really fun, Chris. It's opened my eyes. I can't wait to kind of go back through it. So we'll have to do it
Awesome.
again
Appreciate
sometime.
that.
Okay.
I would love to. I would love to. Thanks so much, Kirby, for having me. I appreciate it.
You bet. Well, that's going to wrap up this edition of Delivering Marketing Joy. We'll see you next time.